taking an absence, make sure you just consult with your tax advisor or just get professional advice.
Yeah, definitely. And then what I'll share here is just a quick disclaimer. There are often exceptions to the things we discuss, and that exception could be you. So this is general information to inform you, to inspire questions, inspire further analysis. It is not by any means a complete consult. So be aware of that, and make sure that you get the nuance around the rules outside of this call. So here to inspire and start conversation. This is not a complete consult. There are always exceptions, and those exceptions could be you. So I think we want to start with some questions that we got. So for those of you that don't know how we work or how we're going to do this, is we have a section on our website where you can submit questions every week that you have from a tax perspective. So we'll try to answer them here. I think we have a few already. Lucy, go ahead and read those out, and Jake and I will take them as they come in.
Yeah, guys. Well, we got the first question, that is, what is the difference between repairs versus improvements? And are either one of them more beneficial from a tax perspective?
Yeah, definitely. So the technical tax question is, is it section 1245 or section 1250 property? And the reason that's so important from a tax perspective is because repairs can be, I'll just give you the punchline, repairs can be expensed. So actually I did a tax return 2 nights ago where the client indicated, hey, 5,000 for I spent 5,000 on repair / remodel for 2 bathrooms. Sorry, each bathroom was 10 grand worth of repair / remodel. And, it came back to the client like, hey, like, I need to know what's repair versus improvements, because repairs get expensed and improvements or, general remodel costs get spread out over 27.5 years. So, the difference is taking a $10,000 deduction, or if you take it over 27.5 years, it's like, $380 per year. So you think that's pretty impactful from a tax perspective? It absolutely is, because that can be the difference between being a profit and, having tax added to what you already have going on, or having a paper loss, where you are now able to get, a deduction and use it as a tax strategy. So very impactful that you're able to break those out. You can't just say it's all repairs. There are rules around what's 1245 versus 1250 property. So the way to do it, and my advice, is typically to have an itemized receipt or an invoice. I know how the world of contracting works. They don't always give you the best stuff. Hey, it's a $5,000 project, not going to get a breakout. I recommend that you create one for the contractor and have them sign it, have them agree to it. It's also good, I think, GC management, to make sure you get agreement on kind of what you're paying for. If you do it yourself, then you're going to want to break out materials versus versus like buying a vanity, which you can't count as a repair. So a little long-winded, but very impactful question. Very it depends question. The way to get clarity is to detail out what those costs are related to.
Yeah, Miguel, second part to that question, just because I do get it a lot. Are you able to deduct or expense your time? Say that you are the person that is going to be making that repair improvement. Can you go ahead and deduct or allocate any time in regards to your tax situation, or no?
Huh. Yeah, that's interesting, because I don't think like a tax person would ever ask that to the tax person, because but no, it's good to know that, like, if this isn't your world, you're just in real estate, you're like, hey, like, I'm spending time on this, like, that's a cost to me. I think that's right. It's an opportunity cost. But that is not a cost from a tax perspective. So there needs to be actual money spent. There needs to actually be cash that comes out of the bank account. There needs to be an actual transaction you can point to. Deciding whether or not you should work on something is really an opportunity cost, not a tax deduction.
Gotcha. Yep, that was the answer I was hunting for.
Thank you, Miguel. Well, we got the second question. Should I be paying estimated taxes for my Airbnb Turo business?
You don't need to. The word should is kind of loaded because it assumes that there is like one way to do things. I think, it's a question of how big is the business? Is this your fourth Airbnb versus your first? Is this year 5 versus month 1? I would say that, assuming a few things, assuming you got one property you recently bought as a rental property, you just started getting some rental income, probably makes sense to get some kind of business set up. Whether you do an LLC or you set up a sole proprietorship is based on kind of a further discussion about the right legal entity, about liability protection, about getting commercial insurance. So, I assume this question is kind of early on in the business journey. So what I'll say is the principle is you should have separate business and personal accounts for sure. For sure. How you do that, are you creating an LLC or creating a sole prop? Those are kind of TBD, but I would say at minimum, I would create a sole proprietorship. I'd get an EIN from the IRS. I think that's also helpful because, when you're working with other vendors, they ask for a W-9. It's better to hand over a W-9 that has a general tax ID instead of your social security number. So, very basic kind of, in month 1 or first 6 months, I'll always say, hey, yeah, set up a separate business, take that EIN, and I think you register DBAs, but you can take that EIN to the bank and create a separate business account and begin separating those things out. We see this all the time where clients are using, credit cards they have the best points on. We'll deal with that. We want to make sure you get the deductions, but we want to move you into a system where you actually have a separate bank. And what, the banks we love right now for our Airbnb clients are the digital ones that you don't need to walk into a retail branch. It's just easier. So we recommend Novo. We recommend Relay. Some of our clients are on Mercury. These are the online banks that feed really well into accounting systems because ultimately you're going to want an accounting system to capture all those deductions.
Thank you, Miguel. Well, we got another question is, what is classified as an operating expense?
It's a good question. I hesitate because I don't know if it's a simple question of like what's a deduction. But the word operating tells me that these are day-to-day variable expenses. So when it comes to doing good accounting, you want to separate your variable costs from your fixed costs. So we can start splitting hairs on whether something's operating or not, or open up an accounting textbook. But from a simple perspective, operating costs are the costs that you incur in order to take on another rental. So linens, buying materials, things that are consumables like Keurig pods, wine, things that you make available to your guests if you do that, toilet paper. Those are things that are operating costs that you need to continue spending. Typically, the way we think of like a mortgage is more of a kind of a fixed cost, even though it could be variable depending on different things. But yeah, operating costs are things you got to do to keep the lights on, utilities. The metaphor is literal in this case. So that's how I think about it.
Thank you, Miguel. Well, the other question, are startups expense deductible?
Yes. Sometimes I kind of wish I had the person on to kind of question like what they're really getting at. But yeah, so startup expenses are typically used in the context that the business hasn't started receiving income. So startup expenses, if you're going to put them in service before you've received $1 of rental income, whether it's Turo, whether it's typically specific to Airbnb or Turo, if you're in one of these businesses and you buy the assets and you want to start deducting now before you've earned $1, well, we've got to amortize it, spread it out over 5 years. So if you spend $10,000 in December, you're not going to get started until January. Instead of taking a $10,000 deduction now, you're going to get $2,000. You're going to spread it out over 5 years. So sometimes we tell clients like, hey, don't place it in service yet. Maybe we'll put it on the tax return, but not bring it over. Because sometimes it's better to just hold on to that. And instead of taking $2,000 per year, just take $10,000 altogether the following year. because you're actually earning revenue and it's going to offset the income in the next year. So they are deductible. There's a way to do it, and it's not necessarily beneficial for the taxpayer. Sometimes it's better to hold on to those and wait till you actually have income in that tax year.
Thank you, Miguel. We got our last question. Well, I'm selling my condo that I have on Airbnb. How much of my OA dues can I count towards improvements that will reduce my capital gain taxes? Any other deduction I can take to reduce my taxes?
That's a big one. And that was HOA, right?
Yeah.
So I assume, and this is the sale of an investment property. Do they specify?
Yeah, she's asking any other deductions I can take to reduce my taxes.
Okay, I mean, I'll assume it's a rental property. So if it's a personal property, you know, there's a capital gains exemption. If it's a business property, one thing to consider is a 1031 exchange if you haven't sold it already. That allows you to sell your current property, buy another property, so it's called a like kind exchange, and not pay any capital gains. I'll say it again, 0 capital gains. You need to buy a current you need to buy a new property that's similar to the first one for an amount greater in order to get capital gains exemption. So, you know, we just did one of those recently. So fact pattern was client bought a property for 100,000, holds on to it, you know, bought it maybe 10 years ago because sold it for 500. And right there is 400,000 in capital gains. There's also depreciation recapture. So if it's a rental property you've been depreciating every year, you're gonna have to pay taxes on the depreciation you've taken. Yeah, that's a punchline for some. So the capital gains can be very painful, which is why a 1031 is so beneficial, because she went out and bought $1 million property, took the proceeds from the 500, got debt for, you know, basically a 50% loan. Banks love that. So took the proceeds from property one, maybe took a little cash off. I don't know. I just know how the tax return looks, but then got a, you know, LTV 60% loan. And now they're in a bigger place getting better rent because they basically just stepped up the prior sale, 0 capital gains, and you continue to be in business. If you need the cash for something else, you know, you can't do that with any other asset. So it has to be similar, it has to be real estate. That's why it's called like kind. Outside of that, I mean, HOA dues, I would say deduct those on your current Schedule E, because you still have to complete a Schedule E if it's a rental property. So deduct your HOA fees. Those aren't really going to offset capital gains. Because remember, capital gains are at, you know, if you hold it for over a year, it's at long-term rates. So capital gains isn't the worst thing. It's a lower tax rate than ordinary. So yeah, I'd say the strategy is actually deduct what you can on your Schedule E, because those losses too offset capital gains. So it doesn't matter. I think you're kind of overcomplicating it. You don't need to put any expenses on the sale. You can put it in the current, you know, income and loss statement for the current year. And those losses, if there are some, will offset the capital gains. So that's how I think about offsetting gains when we have a sale.
Thank you, Miguel. We can continue.
Woo, man, that's tough. So yeah, we moved Q&A to the beginning to get people thinking. I think part of the idea is that you probably showed up with questions, maybe some of them got answered. But also, if you have questions, we're going to do this every other week. Go ahead and submit them, and we'll tackle them at the beginning. So, you know, you don't need to pay for these answers. But again, it's not official advice. So, you know, take it as a grain of salt. Take it with a grain of salt. I think we want to move into the rest of the presentation. So we're now going to present a little bit on the tax tips and news. Jacob and I are going to go back and forth on it. Before we do that, we want to share that we do have for our Airbnb hosts, a host tax essential starter kit. So you get things like, what can you deduct? We've got a whole P&L template on how we set up a P&L when we set you up in Xero or QuickBooks. That's part of the chart of accounts guide, as well as things you should be deducting if you're not, as well as how to prepare for tax season. So your tax deductions checklist, use that QR code and go ahead. I don't know what the cost is, but I promise you it is marginal compared to what our service costs. So we want to be able to really deliver some value without having to pull on our time or schedule a meeting. You do need those schedule a meeting and services at some point. But if you're getting started or if you're a DIYer, this is a really good resource for you for not a lot of money. We're going to quickly just talk about who we are and what we do, in case you're new. But we are a tax services firm. We provide tax consulting, audit defense, light bookkeeping. We're certainly not CFOs, but the reason I say that is because a lot of our clients just need books for the bank. They need books for tax, and we can certainly check those boxes. So simple, shortcut bookkeeping, strategic tax planning is where we live. This is our team here. You can see handsome Jacob on the right from Southern California, myself there, and then our two tax leads, Carla and Mike. So if you do work with a tax manager, you're going to work with Carla and Mike. They're absolutely the best people. I trust them with even our business returns. We have some investments. So definitely, if you want to know who we are, really group of people that are tax nerds that want to have an impact at the small business level, because it's really hard to come by. So I'm going to switch it over to tax news. Jacob, let's make this conversational. Pick anything on here that you're seeing, Jacob, on the three, and why don't you just riff, just give me some updates so I can drink some water.
I kind of like the third bulleted, missed the filing deadline. Taxpayers who owe missed the deadline without requesting an extension should file quickly to limit penalties and interest. Consult your tax expert to file an extension for your taxes. Yeah, so I mean, I feel like that's applicable, right? I mean, you know as best as I do, tax people tend to either file an extension themselves or do it the last day at the last hour, right? And certainly people have missed the deadline, especially those that possibly do owe. So what happens then, right? I do know, for example, once again, guys, I'm not a tax professional. I do know that you incur penalties, right? Every month that you don't pay, there's interest as well, right? So what are the exact, I would say, scary things to be considered?
Well, I think, I would say, yeah, you're not an official tax expert, but I think, you spend more time in tax than, your average, like, multi-millionaire 10 property investors. So I think you know stuff pretty well. But yeah, so the reason we bring this up is just what's in the news and what's on the horizon. Deadline to file is 4/15. The deadline to file can be extended to October 15th for individuals and C Corps. But the deadline to pay is still April 15th. So what Jacob's highlighting is if you do owe, it's a loaded if, right? Like, how am I supposed to know without my tax return for clients? We help our clients with. But if you're waiting on a K-1 or, your employer needs to restate your W-2 or you're working with your ex on who's going to claim the kids, there's things, or your bookkeeping is still getting, perfected because you want to break it out by property. There's so many things that may require you to say, hey, let me not just file right away, that we have the ability to get close on what we think we're going to owe, and make a payment if we need to make one. What we do for our clients is we try and get to kind of an 80% number. Sometimes that missing thing changes a lot, but we're trying to assess if we can limit the interest and penalties because it's still due 4/15. So if you absolutely don't know, my trick of the trade is I look at what I owed last year, if I'm a serial ower, and I will pay 90% of that. It's not a safe harbor, meaning you're still going to pay interest on whatever you didn't pay, but you're going to pay less interest because you've got something in. Some years, this is kind of how we work with our clients, some years we get a refund. So some years I'm pleasantly getting money back. Some years I'm not happy that I've got to write an extra check, but hey, took a low interest loan from the IRS where I got to use my money and capital between April and October, and sometimes that's fine. And then another reason to wait is bullet point 1. So, we're saying recently passed legislation. It's not fully passed and signed. It's just passed by the House. So the Tax Relief Act for families, American families, we talk about it in a bit, has provisions that affect this year's tax, including with respect to bonus depreciation. So if you file now, the IRS says don't wait to file. However, if they do pass, there's a question of whether you need to amend your tax return. I mean, Joe, you've seen it before. Like, I don't know what your thoughts are. You telling, like, what are you telling clients and folks that are calling in on, do we wait for legislation? Do we file now and change later? Like, how are you thinking about it? How are clients thinking about it?
Yeah, that's a good question. I feel like if it's a first time conversation and let's say that you guys are considering using us for this tax filing, I say let's go ahead and just wait, let us handle it. If you're really, really under pressure, once again, kind of Miguel's tip and trade would be to pay 90% of what you paid last year if you're looking to owe. I would say there's not really a perfect answer. What I'm telling people is, hey, if you're going to come on with us, we'll get you in, of course, prior to April 15th coming up. We're going to go ahead and file you on an extension anyways. With that extension, we're going to go ahead and if we are projecting to owe, once again, we'll put together a projection for you to make at least a payment by that deadline. Yeah, I mean, I don't think that if you want to work through an amendment process, it's basically just like refiling your tax return. I would say it's more of a pain in the butt than just waiting, to be frank with you, in my opinion. What are your thoughts though, Miguel?
No, I agree. I think avoid amendments if you can.
Yeah.
But we have the law of the land now, so I think maybe the most reasonable strategy is to. I'll give you the most reasonable strategy, and I'll give you strategy. So the most reasonable strategy would be to make an estimated payment based on the law of the land now. So no change in the child tax credit, assuming bonus is phasing out down to 80%, and making an estimated payment and seeing if Congress gets it together. We did another webinar for our startups, and they have a rule that is completely completely horribly screwing startups that do R&D. And they're basically faced with the same thing where the tax swing for them is so big, things are held up in Congress. What do they do? So we said is kind of the reasonable thing is to assume that the law of the land is going to stay. If you have an estimated payment, make it, right? Deal with the pain right now. Okay. And then wait. And the way that Congress works is right now is that they're going to come back and they're going to work on funding the government. So end of times, Rome is falling. We're just trying to get federal workers paid right now, right? We're just trying to keep people building roads. Like they're going to deal with that first, then they're going to break for summer, tough gig, probably raise money, probably campaign. And then they're going to get into a serious session in September after the summer break, because they've got to do things that are going to affect the election in November. So, last year I thought Congress would get together and pass tax reform. They didn't, so that's carried over. And these are things that I think have already they've been talked about in tax circles for so long. Like, hey, we've got to fix this. We got to fix this. I think there's a chance, my personal opinion, that these things do get put into locks. I think that whether you're Democrat or Republican, I think it hurts whoever doesn't pass it. So right now it's stuck in the Senate. You need 60 votes in order to bring this to a vote. The Dems don't have it in the Senate. And the Republicans, I think if they bring it to a vote and they don't get the 9 votes they need to pass it, they need 60. They are going to all look bad, including the Republicans for not passing it. So I think it's going to pass. So I'll give you the aggressive strategy, which would be assume that we're going to get 100% bonus depreciation back, or assume the rules would pass, make an estimated payment based on that position, and then it's a wash by the time it gets to filing, because you were right. You know, we got 100% bonus. So you can basically discount your tax bill by 20%. But it's aggressive, because if it doesn't pass, and I've been wrong before, I thought they were going to pass it last year. I have clients who still are like, Miguel, what the heck? I'm like, hey, like, I can't control what Congress does. If we're wrong, then we're gonna have to make up that bill with interest. So really a question for you. And usually when I work with clients, I'm trying to feel out, you know, like where they land. And like, yes, like, oh, let's just make that extra payment, get that return. Like, that's a great idea. You know, client comes and says, hey, I'm a libertarian. I don't want to give the government a cent over what I need to, and I'd rather pay them the low interest. I'm like, that sounds great. Let's go ahead and do that. At the end of the day, we want to make sure that we're you know, I think having a strategy that works for your risk tolerance, and that we're making payments based off that, and that we're not leaving a tip, right? So there's no, you know, I think every place now has like a little kiosk where you can add a tip. The IRS should not have it. No, we are not going to start tipping the IRS. So yeah, I think, you know, consults are the way to work through that. But also, I mean, I think I love it when clients come to me and they're like, hey, this is what we're going to do. And then the question is like, okay, great. How do we support you? Like, do you want us to prepare a draft return that gets close to that number? How do we support you if you're in a position? So I would say, you know, for those that don't work with us, come to your tax advisor with some of these. And, you know, I think a lot of times tax advisors are like, hey, like, no, I don't want to talk about this. I don't want to plan. Like, just, do you want to file an hour later? If that doesn't work for you, maybe that's not the best tax advisor. But I think for us, we want to make sure that you're educated as clients, and that kind of what you want to do in terms of being aggressive or reasonable, or hell, I'm going to file and amend later because I don't want to think about it. That's a way to do it too. The key is to kind of work through it, think about what works best for you.
Exactly. Yeah, no, that's really good.
Yeah, well, Jacob, we have tax tips. Just want to do a quick time check because we're at the half hour. I think we wanted to save what, like 15 minutes for Q&A? Is that right?
Yeah. I think that's a good amount.
Yeah. So I think we want to talk about a few tax tips. Jacob, feel free. You can ask me a question here, or you can kind of give a quick overview. I know you wanted to talk about this one. How would you like to roll this?
Yeah, let's just keep it up here and just have everybody read through it really quick, just at least the bold items, and then let's just, same like last time, just have a discussion about it. So when you have to pay income tax at capital gains rate on any profit you earn from a sale, let's see. So why don't you just speak a little bit about this, Miguel, and let me see if I have any questions from you. Just putting on my client lens here.
No, definitely. So this has to do when this involves when you buy a property, maybe you live in the house for a period of time, and you put it on Airbnb. So you know, I talked to a real estate agent once. They said the best strategy you can have for acquiring real estate is to live in the home for 3 years, move out, get another, you know, residential loan, and then turn that property into a rental. You can kind of rinse and repeat that process, and you'll end up with low interest rates and low money down rentals. And there's caveats to that, and I'm sure there's reasons why that doesn't work or why that's not best. But basically what you end up with is, if you do want to sell, you end up with having this period where you lived in it personally, you lived in it, or you didn't, and you lived in it personally and you rented it out for another period. If you lived in it for 2 of 5 years, you get the residential exclusion. So you get 250,000 exclusion from capital gains, 500,000 if you're married. So it pays to do the math. And even if it's shorter than that, there is kind of a prorated system to get some exclusion. It's called the Section 121 exclusion. So be aware of that. That if you have a property where maybe you lived in it 2 years ago, understand that clock is shifting. You know, so if you sell it 2 years from now, maybe you only have 1 year in the property. So it might make sense to sell within the year if you want that exclusion. And what you've got to trade off is, does the savings of 250,000 in capital gains save me? So 20%, 250,000, that is 50,000. Is that greater than the appreciation I expect in the next year? So if you think property values are going down, it actually makes sense to sell that property, or staying flat even. It might make sense to sell that property within a year instead of going out a year. So again, 2 to 5 years, and that clock is shifting. So if you look back at the last 5 years and you have 3 years, just know it's going to be 2 in 1 year and 1 in 2 years. So hope that makes sense. It's probably easier to show visually, but
yeah. No, and also too, I mean, kind of a unique situation that I stumbled across on a call a couple weeks back was a gal asked me, "Hey, I'm thinking of buying a property. I only think I'm gonna live in it for a couple of years. I know that there's some stipulations about a recapture payment that's going to be needed if I do take and claim depreciation. In that case, if that's kind of your exit strategy, should you or should you not take depreciation? Does it make sense to pay that recaptured depending on the depreciation schedule? Does it not make sense to take it at all? What are your thoughts there? If that question is coming out clear.
Yeah, no, again, and I love these questions because, and I mean this in a very curious way, that like tax people would not ask those questions because we're in our own world. These are like, these are real considerations, which is the question I heard is, hey, I know I have to pay back depreciation. Should I not take it?
Right.
One, one thing I'd say to that is that you're probably going to be taxed. If you take no depreciation, you're probably going to be taxed throughout the life of the asset, which takes away the main benefit of real estate from a tax point of view, because real estate is great because you get cash flow, but a paper loss. And from if you go out and get a loan from the bank, I mean, the bank looks at the asset and they usually add back depreciation. So the banks love a good rental property tax return. And even though they see like a $20,000 loss for the year, they know how to get back to what the actual cash flow is on the property. So I think kind of the default position of taking depreciation is a very it's already kind of a good strategy. So I would be very careful to change that, because then you would have a very confused banker. If you ever looked at trying to understand like, where's the depreciation, you'd have a confused IRS agent, like, why did they do that? And you wouldn't have the tax benefit throughout life. There's this concept that, I have to pay it back. Well, when you pay it back, you have the proceeds from the sale.
Right.
Assuming you don't have an exclusion. You have cash. Your cash, like what you don't want to be is cash poor and have a tax bill, which is what you're doing by not taking depreciation.
Interesting.
What you want to be is you want to be cash rich when you get that tax bill, which if you do things right, you'll have it. And the way inflation's going, I mean, property values, actually, it's a logical statement. Property values, assuming all things normal, like property values can't go down in the context of inflation. So yeah, I think you definitely want to take depreciation. And then I think too, like the technical finance argument of like time value of money, saving taxes today, because of where inflation is better than saving taxes tomorrow. Like just very simply put. I probably should have just said that.
No, that's good insights, because yeah, I mean, I'm sure that if you hopped on a call, I get a lot of conceptual questions, right? I'm not you usually, when clients are reaching out to us, or if you want to become a client, there's a reason why you guys aren't tax professionals, right? So you guys are asking really good questions that are I would say more conceptual than technical. So that's why I always like to kind of put it through the client's lens to ask Miguel, because then he can get technical with me.
Yeah.
But no, I appreciate that, Miguel. It's good insight.
Oh, for sure. I think we had an example here we didn't cover. We can just leave this up for a second.
Okay.
So again, the thinking is that these, if it's your principal residence and you sell it, if you're married, you don't have to pay taxes on the first 500,000 of gain. So what's happened though, if you bought in the last, I don't even say if you bought in the last 5 years, you're in a hot market, like I'm in Austin, I mean, we've seen property values double over the last 3-4 years. Maybe they're coming down a little bit, but like that 500 is, we're either close to it or it's gone.
Yeah.
So I think it's important to kind of, if it's your principal residence, the 5-year time period doesn't matter. If you turn it into an Airbnb, it does. If you turn it into a investment property and you depreciate it on your tax return, oh, does the IRS know? Yeah, I mean, there's a paper trail. So they can find out. I can find out, so it's very easy to check. So that 2 to 5 years, like, it's real. Like, we're not changing dates. Not to scare anybody, but like, we're in a state audit because states are typically, income tax states are the ones that are typically the most aggressive with making sure the rules were followed, because they just assume that you went to H&R Block or you did it yourself on TurboTax, and they're like, hey, this is low-hanging fruit. So income tax states, Northeastern Seaboard, Pacific Northwest, West Coast, all the coasts, right? They're going to look at this. So you don't want to be cute on a tax return. You don't want to lie about that 2 to 5 years. And it's traceable. So, was there a tenant? So this audit I'm talking about in California, like, they're looking at tenant records from 2016. They're pulling utility bills to see whose name the property is in years ago. So you definitely just want to do this right. You don't want to get cute about it.
Exactly. And what would you say for these strategies for our clients? What's good record keeping track of those expenses? So like your utility bills, keeping a folder of them. What's best practices just to prove it for yourself?
Yeah, it's a good question. I don't know if there's like a best system. I mean, I think the best systems I see are kind of digital folder structures that have things like utilities. If you are going to long-term rentals, then always keeping those tenant landlord agreements. You got to have those, especially in states like California, which aren't very friendly to landlords. So yeah, I think digital record keeping and having a library is kind of critical. I know that I have like peers that keep everything in file folders as like tax. We're a 100% digital firm. So that's where I'm coming from. But if you have a safe with all this stuff, that's fine. But I'd still scan it digitally. Utility bills. And then I think now we kind of have an existing repository in Airbnb. So I can go to Airbnb and I can go back 5 years and I can pull the gross transaction statement, and that tells me the days. That tells me all the rental days. So I think that information exists externally. I just think it's best practice to try to pull it into your own library.
Right. Yeah, my rule of thumb, if you guys have ever talked to me, I always am a big fan of over reporting over anything else, right? It's better to have more stuff than not, and be in a bind and have to go hunt down that information.
For sure.
Depreciation methods and schedules. Okay, so a lot of times, Miguel, you already know, a bunch of you guys do come to me asking about depreciation. What does it mean just right off the bat? Can I depreciate my house? Is depreciation a viable option for me? The always short answer, like Miguel kind of mentioned previous, is going to be yes. Certainly that's going to be one of the methods that we do use to reduce your tax liability. Miguel, so standard depreciation on a house, 27.5 years. What are some ways, and we'll probably get into it next, so I might be jumping the gun, to accelerate that? Say, for example, you have a really good year income-wise. Once again, a lot of our clients, this isn't their full-on day-to-day. They might have a W-2 job where maybe they're making $500K. Let's say in 2024, they got an increase in pay. They're making right around 700. What are some ways to lower that if you are looking that, hey, I'm going to be pushing to the next tax bracket?
That's a great question. I'll just back up just to recap what you said, Jacob, because I think it's important to understand that, the main constant depreciation is you have some value that in an asset, sometimes in an intangible. I won't get too wonky there, but it's got a life of over a year. So you are going to need to spread. The IRS says, hey, spread that out. Like don't take all, you bought $1 million place, don't take $1 million deduction on this year's tax return. Spread it out, 27 and a half years. If it's commercial, it's 40 years. If it's international, it's 40 years or 39 years. So the question that you're posing is an advanced one. And, we have very, I think our group of clients are very attentive and attuned to tax strategy. So, that's the reason they come to us instead of doing it in TurboTax. They're going to say, wait a minute, we hear there's a way that instead of doing, $1 million over 27 and a half to, maybe get shorter treatment on depreciation. And that's where we talk about cost segregation. So we'll just skip this slide for now. Let's get into the cost seg. So cost seg is essentially the divvying up of assets and property in a purchase of a, I'll just call it, vacation rental, just to make it specific. So instead of saying, hey, we got one place for $1 million, and it even works at 300,000, 400,000. I mean, cost seg works like across the board because what you end up doing is you say, hey, it's not just a house. This is a component of various types of property. I mentioned it earlier, section 1245 versus 1250 property. And if it's in the right category, you can depreciate it over 15 years, 10 years, 5 years, 7 years, shorter period, right? So if you now say, hey, 500,000 is 20 over 27 and a half, but now the 500,000 is broken up across these shorter time frames, your annual depreciation for that year is going to increase. So we don't have the time here. Maybe when we do this again, we can actually show an example of how that works. For now, you're just gonna have to trust general numbers that look, $1 million, 500,000 over 27 and a half years would get you something small. If you take that 500,000 and make 100 of it depreciable this year using bonus depreciation, have 100,000 plus whatever that small amount is. And then the other amounts can be depreciated over, 15 years. So you get a less small amount that get added to that. So you end up with potentially a depreciation deduction of 150,000, 175,000 instead of 5,000. It's a huge difference. Yeah. So for those high net worth clients, or even like to qualify for a loan today, you've got to make decent money. So even if you're low six figures, it doesn't matter where you are, having that upfront tax benefit is going to be better from a net present value perspective. So you're going to be able to get back if we can put it in service and get the short-term rental exception, so that we don't have to suspend those losses. We can take them against our income. That's going to be a big refund. So yeah, cost seg works is the short of it.
And then last talking point, we'll move on from cost seg is I remember I was at I'm in Southern California, guys, at Long Beach real estate event. I don't know if you remember, is when me, Sean, and Ash and all went. But they were talking about cost segregation, and of course it makes sense for properties over $1 million. That's usually the case over here in California. They said sometimes it makes sense for 500, but I was hearing from you there is a case, and it is widespread across. If I have a $300,000 property, let's say I'm just in the Midwest, right? Property's cheaper out there. You would still suggest to look at the numbers to see if it is a viable option for you? Yeah,
definitely.
Awesome. Okay. They also
even if you take away zero, from the numbers I shared, if you go from a 1,000 annual deduction to 30 or 40,000, I mean, even if you make 60,000 a year and paid 6,000 in taxes, like you're not getting a $6,000 refund. You're getting all your taxes back. Right. So we charge around, even for small properties, we're very competitive when it comes to our cost seg. So we're around 2K, depending on the property size and value and intricacies, but paying 2K to get 6 back, and those are kind of like worst case scenario numbers. I mean, I would,
it still makes
sense, but like I would take that deal.
Of course, yeah.
And I wouldn't do it on my own. I mean, I just talked to a former colleague who knows how to think about cost seg. He's like, hey, I'm not going to be able to generate these schedules and create documentation. So he's like, I'll just have you guys do it. You know,
Yeah.
he knows how to think about it. But actually doing it, I mean, that's why we have staff that actually work on these reports. We do
Yeah.
appraisal calls, you know, you've got to tour the property. So yeah, I think it's definitely worth it. It's a little bit of work, but you know, why do it yourself?
Yep.
Well, let's move to Q&A, because I think we're starting to dwindle energy wise and attendees wise. We brought some attention to tax preparer scams in 2024. I would just say the most interesting one, maybe we'll like, you know, blast it out in a blog post, but emails, calls, any contact from the IRS, don't trust. IRS sends letters, 100% sends letters. If you're in an audit, there is a way to, you know, maybe you'll get an email from an IRS agent. But typically, if you're getting a call or an email, 99% of the time, it's going to be fake. If you get a voicemail from an IRS agent and they list out a long employee number, maybe it's legit. But also, if you're a scammer watching this, now you know to do that. So be vigilant, and then check the URL, guys. Like I tell my kids this, I tell my wife this, like, you know, send me like a link or like a screenshot or like some communication, and I'm like the URL is like IRS pay your taxes now or go to jail.com. It's like,
Right.
like that's not it. It's .gov. It's .gov. 100%. It's .gov. So yeah, always check that. I think when you pay, like when we tell our clients where to pay, we give you the link. If we don't, ask us for the link. We'll give you the link where you pay. And also, like, tax preparers are getting hacked. Check the email addresses. I got an email from a client that said, hey, like this email isn't going through. Like, can you send me something? And I know this client, it was his name, like at Gmail. It's like, that's so weird. Like he's never emailed me from that email. And you know, it's actually legit, but it's just, these things of just being vigilant when it comes to tax are really important. We also say, like, don't email your tax documents. You know, that's why we have a portal. But you know, goodness forbid someone creates Miguel at sharedeconomyaccountant.com, says, hey, send me your W-2. It's like, we would never do that. Now you've sent your W-2 with your tax ID. They can now go file your tax return. So be vigilant. Do not send your tax documents over email. And let's move to we're just gonna have to move forward. Let's move forward to closing thoughts. So Jacob, you want to take these?
Yeah. Closing thoughts on the last thing, make sure that you keep all of your information secure and private. Best rule of thumb, even if you're not working with us, just don't send anything via email. Scan it, upload it to a portal like ours. Just keep yourself covered. If you do get communication from the IRS, you are our client. Make sure that you do upload it to your client portal, ping your tax advisor, let us take a look at it to deem if it's a scam or not. Yeah, closing thoughts. Make estimated tax payments before 4/15. Once again, punchline there is it's an extension to file, not to pay. We got to make a payment prior or on 4/15. So keep that in your calendars. Evaluate how depreciation can benefit you. Once again, we had a pretty lengthy conversation. Pretty much across the board driving message is depreciation is going to be your best friend. And once again, avoid your tax scams there. Just be vigilant. Make sure that, once again, you do use those best practices we just discussed.
Definitely. Well, we have a little bit of time for some Q&A. Lucy, did we get, or if you have questions, feel free to send them in the chat. I'll send a quick, yeah, there's no questions yet. I know we had questions that were asked before. Lucy, do you want to ask some of those questions?
Yeah, we got some questions here. How can I file a tax extension, guys?
How can I file a tax extension? So if you work with a tax firm, they'll file your extension for you. That's usually part of the engagement. If you are a DIYer, that means that you probably have a software of choice to use. You can file an extension with TurboTax, with H&R. And if all else fails, wouldn't recommend it. You can file an extension with the IRS, irs.gov. It's harder though. It's
Yes.
harder to file a tax extension on the IRS website. Is that a surprise? I don't know. I feel like that should be easier, but it's actually hard.
Yeah, if you guys have ever visited the IRS website, it's not very user friendly.
I think it's getting better. I'll give him that. I think it's getting
It
better.
is getting better, yeah. But still not my favorite.
Yeah, you can file, the IRS, maybe we'll cover it on the next topic. You can file directly with the IRS now.
Yes, I did see that because I think they're trying to compete, or no, IRS is allowing you to do it for free on their website, right? And I think I've seen like the competitors, TurboTax, H&R Blocks of the world, are providing a free platform for them to compete with the IRS, funny enough, to keep their clients, right? So yeah, once again, if your situation's pretty extensive, like most of you guys are in the shared economy, H&R Block, TurboTax, they're not necessarily going to be the best fit for you guys. They're not going to allow you to ask the right questions to get the best return.
Yeah, I think too, the free versions are very limited in terms of
We got another question. Can I use section 179 for car depreciation?
Yeah. So 179 applies to cars that are 6,000 pounds or heavier. Still the rule of land. If you want a G-Wagon, there's a tax benefit. Just note that it has to be used for business purposes. So, don't be like the client that we had to part ways with, who bought like 2 or 3 heavy Lamborghinis and was like, here you go, and didn't really have business income. That's just not going to fly. So, I think, what's the expression? I forget the expression, but basically don't be too aggressive.
Yeah, I think rule of thumb is 51% business use. Depending on how aggressive you are, if you want to really walk that fine line, great. I personally wouldn't. So just keep in mind, it's got to be above 50%.
Yeah, that's right. It has to be above 50% in order to get 179. So it can't be, I drove at 10% for business. Typically we want to see another vehicle if you're getting something big and expensive, but yeah, still an effective tax strategy.
Then really quick, Lucy, we did have one pop in here from iPhone 2. Welcome. Do you recommend a certain DIY software for filing?
I can't personally do that. No, no. I mean, I'd have to use it seriously. I mean, we work in Intuit's ecosystem, so we use ProConnect, which is the pro version. But like, I can't recommend. It's like asking like a F1 driver to recommend an economy car. Like I can't do it. So yeah, I mean, I definitely don't think you should paper file it. So DIY software is better, but yeah, I don't have like one you should go to.
We got another one. How can I maximize the depreciation deduction for my Airbnb property?
Cost seg. Next question.
Okay, let's see. And we got another one. What are the most effective depreciation schedule methods?
Cost seg.
I really want to know that. Yeah, there's different methods. So straight line, accelerating balance. Typically, if you don't do accelerated depreciation, it's going to be straight line. And the IRS has a dictated depreciation schedule called MACRS, M-A-C-R-S. That is the default way that tax professionals, as well as the IRS, will depreciate. So you can actually pull that table up. Like if you're wondering, like I'm in an standing office desk right now, and you look up office desk on the MACRS table, it'll say 5 years, I want to say. Basically, the table will dictate the time period over which that specific asset should be depreciated. And if you want to get, if you want to bonus it, you can. So you can bonus 5-year property. It's just bonus to 80%. So depreciation schedules, MACRS with bonus depreciation, and that's what we're doing in cost seg.
Perfect. Thank you, guys.
Yeah. All right. Well, I'll take the silence as we're all done.
Yeah, we're done.
Done. Well, good job, guys. We also have a check out our host tax essentials starter kit. It is a great way to get some of the knowledge that we share here without the full on service package, which, I think we really do believe that we want to educate the community as best we can. Tax strategy should be your friend, the uber rich advisor who's yours. So with that, we're going to wrap. If you have any questions, I think we have Jacob's email. Jacob, what's the best way to get in touch with us if somebody wants to work with us?
Yeah, very good question. So any of those ways, you certainly are going to get a call from me. So I will be the direct person you guys will talk to initially. So I would say the best way would be you can email me directly. I'll get back to you within 24 hours. Just let me know, hey, I was on the webinar, and I'll make sure to get this call scheduled with you. You can call our number during working hours, depending if everybody's busy, whatnot. You will be able to submit essentially a form via the phone. Also, you can go ahead to our website and just go ahead to get started, and it'll ask you a couple questions: name, email, phone number. That direct form will be sent to me. So then I do always appreciate there's going to be get to know more, or essentially a text box for you to fill out some more information about yourself. I do appreciate that. So it helps me kind of prepare on what you want to talk about. So any of those methods, if you already have my contact information, like I think I did see Brad in here, he has my personal information. Go ahead and reach out to me personally as well.
Thanks, everybody. It's busy season. We are glad we found a way to connect with you somehow, even if it's not one-on-one. Thank you for joining and spending some of your time with us.
Yeah, thank you, everyone.
Thank you, guys.